But speaking of, to deal with a calamity or to move forward, is it best that you pay off debt first or just start investing?
I mean, we would look at that. It depends on where you are in terms of your life stage. So for some folks, debt might be more important to pay off. Obviously, there's a mathematical answer that makes this very simple. Can you earn more investing than you are paying interest on your debt? Is kind of the simple rule of math. So the example that I always love to give, back in 2021, when mortgage rates were extremely low, a lot of folks refinanced their homes. I think the average national mortgage rate is somewhere below 4% at the moment. For a lot of folks, they're earning a lot more than 4% in the market or in their investing accounts. At one point, you were getting 5 to 6% in a money market. So it would have made more sense in that time period to actually invest the funds. Again, this is purely mathematical speaking. Whereas in a market environment where mortgage rates are maybe closer to 7%, well, if you said, hey, Ryan, you're the CIO, what are your thoughts on the markets? I think I'd be hard pressed to say over the next 30 years that you're guaranteed a 7% rate of return in the market.
Right.
So in that instance, it comes more of a question about, well, what else is going on in your lifetime and what stage of life are you in? Are you trying to accumulate? Are you trying to retire? Are you a stressful person that doesn't want debt? There's a lot of nuances to that question. But again, the mathematical answer is it just depends on what are your rates of return relative to the debt that you're paying on.
Yeah, that question, I mean, it brings to mind a case that Jordan and I worked on this year with a client, pharmacist, high earner, but just a bucket of student loans. And just navigating the complexity of financial math, to Ryan's point, it's not something that is in everyone's wheelhouse. And that's really, truly where we come in, is like simplifying the math so that you don't feel overwhelmed by a decision. And this is a husband and wife that were struggling. They were really wanting to know what the way forward was. And I'll let Jordan kind of talk about like maybe the strategy that we use within the snowball effect or the snowball method.
Yeah, so essentially in our planning software, we have the ability to gather all of the debt information. And as Ryan mentioned, we really prioritize the highest rate debt first. Because we know over the long term, that's going to be the one that accumulates the most interest that you're sending out. And so the first thing we noticed with this client is that a lot of the student loan debt was private, and it was financed at double-digit rates. So the amount of pure interest that this couple was paying on a monthly basis was preventing them from freeing up cash flow for a lot of other things, such as starting their retirement savings, which is pretty essential. So clearly articulating to them that the first thing we want to attack is the double-digit interest rate debt. We did recommend that they refinance since they are private loans. And by refinancing, we were able to clear up hundreds of dollars in their monthly budget that they can use for other things. But really freeing that up allowed them to make larger payments on the refinance loans. And we gave them a timeline saying that if you stick this out and we continue to knock out the highest rate first, you can be debt-free in a matter of 7 years. When you thought you were never going to make it out of this situation. And being able to give people confidence and clarity, it goes a long way as far as fulfillment and gaining the trust that we look to do in every relationship.
That makes sense. I mean, you walk into it not understanding, and we always see the ending, and it's, which is subjective, and it's all circumstantial, but our endings are different than your endings. And I think that's what's great about getting into this world, into a space that makes sense to better understand the situation, so that there's a positive, or there's actually a rainbow here that you didn't realize.
Absolutely.
Follow this protocol, and I guess to clarify the clarity of the question is that, yes, can they be balanced? Can you pay off debt and invest? Can you focus on retirement and continue paying off debt? Is that something that you can balance?
I mean, I would say, like, again, a rule of thumb, and we're not a practice of rule of thumb, so don't think that everything we do comes from this. But I would say it really does make sense a lot of times to balance debt versus investing. You know, debt pay down is a lot more of a short-term benefit. In the example that Jordan and Johnathan just gave, this was a 7-year runway for these clients. But really, starting day one, that first day they made their debt payment, they probably felt a lot better knowing that they were on track to do something. What we also like to do is think further out than just a few years. We want to think 10, 20,
Sure.
30, maybe it's 60 years if we get someone in their 20s. But the comments there are ultimately, yeah, your dollar today is going to be worth less in the future. So how do we balance out the debt versus investing for your future? Yeah. And ultimately, that's probably the balance is a good combination of the two, because by paying down debt, you're freeing yourself up to do more in the future. And by investing, you're freeing yourself up in the future just from the accumulation of your investments. So again, it's a balancing act.
Yeah, it makes sense. It's a complicated equation.